Okay, hello everyone. Today we're going to talk about um, this AI and the market crash. So, in this video, let's go at it at a statistical point of view. So, we are like doing all the researches and this and that, and everyone is just copying everyone else's videos and saying, okay. So, let's see what has happened and let's see what is going to happen, like from a past to future perspective. Okay. So here what I have done is I have taken the composite index of like three big indexes or three big markets from USA. One is would be the New York Stock Exchange, and the second one would be NASDAQ. The third is S&P 500. Okay. Now let's zoom this everything again. Okay. Now let's start with the biggest, the New York Stock Exchange Index. So what I have done here is I created a chart with all the depressions and stock market crashes or all the crashes with the recovery period. And I mapped this index from 1907 to 2022 until now, up to current market 2023 to 2026. Yes, I should tell this chart is like generated, like created with AI. So here all on the red, like the blue line is the indexes trend, and the ash, like a gray color, the bars are where the recession period. And I've shown here is the bear market, 1907 panic. This is the Great Depression, again 1937 to recession, and World War II dip in 1996 bear market, and oil crisis, Black Monday, dot-com bubble, and everywhere. And I will put here what has happened, like how much it has lost, like the gain. Minus 48%, minus 60, minus 86%, minus 54%, minus 54%, minus 30%, minus 22%, and minus 45% likewise. So out of this, all the drops, the Great Depression of 1929 has the greatest dip. And again in 2018, we have a minus 52%. And COVID also, like COVID to post-COVID period has about 34% to 24% in between. And the recovery period, how long it took, again, the Great Depression had the longest period of 2.9, but it's likewise, we are even still recovering from COVID as we speak. Now, if you normalize this curve, like from New York Stock Exchange, if we normalize it and if we predict a normalized comparison, and if we map all this, and if we run a correlation, right, similarity to current market based on correlation of normalized returns, you will see a pattern here, right? So now the current trend is very similar to all other previous recessions or market crashes. If you can see from even from 1929, it's showing like 8% correlation. But if you go from 1987 Black Monday onwards and up, it's close to 50%. And inflation from 2022, like the COVID crashes and everything beyond this, it's very similar to the current market. So it's predicting. Now I thought, okay, it's going to be on one index, but let me check all the other big three indexes of USA, right? So if you run the similar statistics for NASDAQ, and if you map the same crisis and the big ones, .com 2018, 2020, inflation bear and everything, you can see similar pattern, right? And it shows similar 48% negative, 27 negative, negative 27, negative 33% return, and during the dot-com bubble, 78% negative on NASDAQ, right? So NASDAQ is the online where the major companies are listed. And again, if we normalize the comparison, if we normalize the trend, and you will see here, okay, if you run the correlation again, it's showing similar statistics. And if it's from dot-com bubble, from here, Black Monday, everything is showing more than 50% correlation, minus 49, 50, 3, 71, 83 correlation. So correlation is to 1. So the entire correlation is compared to 1. 1 is perfect correlation and negative 1 is perfect incorrelation and anything in between. Okay, so this is positively correlated. All this trend over here is, it's surprisingly, this peak is matching with all other inflation like 2022, 2020 COVID crash, 2018 financial crisis, and it's matching. So what does it say is that this is not a joke, like it's happening right before our eyes. That's the and it's done by AI, and we can analyze the situation by AI. That's the biggest joke here. Now, if we see the same trend, and if we come back to S&P 500 from 1928 to 2006 up to now, I've used like May data, but still, the Great Depression shows minus or negative 86% return, minus 54% return, and again similarly. And if you come down, normalizes, and if you run a correlation statistics on the normalized daily returns, you will see a similar pattern again. Say COVID crash 0.41, meaning 41% it's correlated, positively correlated, and dot-com model positively correlated, and 2022 inflation from COVID and whatever, it's showing 86%. So 86% correlated, 83% correlated, and 82% correlated. Every time the highest similarity is close to the 2022 inflation bear market. So over here. So this trend is showing that this area it's gonna fall. It's gonna crash. Sooner or later it's gonna crash. And that's what all these three indexes is pointing out. So this is some statistically showing it, okay, correlated. So the pattern is repeating itself, and it means it's gonna flop, or it's gonna break at one point or closer. So what you can do is save your money, make sure your savings are secured, have a healthy cash reserve, because the rich who have wealthy cash reserves are going to make a lot of money when the market crashes. Everyone, including Elon Musk, whoever it is. The common man, like you and I, we are the ones who are going to pay for everything when this breaks down. And it's going to be an ugly picture. Thank you.